Hi, everybody, and thanks for joining us for our Q1 2022 market update and fund recap. I've seen better days, and the bottom drops out. Obviously, we all know the song, and I'm not even going to try to sing my rendition of that. But yeah, things are certainly changing here in the markets as we speak. So, just starting off, as far as a recap of the first quarter, it was unreal. Global bonds had the worst drawdown ever. US bonds, the third worst Q1 since Civil War. The US yield curve is the greatest Q1 flattening ever. Commodities have had the best start to the year ever. Oil had the best start to the year since 1999. Um, Regular gasoline at the pump is fastest rise ever to record highs. US stocks had the third biggest short squeeze rebound in March since Lehman, after the worst start to the year for stocks since 2009. The ruble was stronger against the dollar in March after an ugly January and February, and then across all major asset classes, gold outperformed with stocks and bonds ugly. So, within the context of big movers in the first quarter, long dated bondholders are now making 3% on their portfolio. Hooray! But the value of their holdings are down nearly 22% in 4 months. So, going back to December to now, this is why no matter which portfolio fund that we run, be it stocks, bonds, commodities, precious metals, crypto, whatever it is, we're using the active strategy to sell and protect even on bonds and fixed income to avoid these sort of 20% declines or worse if the selling keeps going as yields keep rising. So we'll see where bonds continue to go from here. But looking at the ARK, I'm sure a lot of people out there have heard of Cathie Woods and her ARK Innovation Fund, which was all the rage back in 2021. As anyone in that basket of innovative garbage had a nice wealth impact in 2021. However, the wealth impact has now vanished, to say the least, with the ARK Fund being down 57% since its high back in November of last year, with no end in sight. So what's going on in the world of bonds and tech? So the biggest culprit behind the tech collapse are the same entities that enabled the biggest bubble in history, and which they're all trying to pop in a way that does not spark a hard landing. So calling it the charge of the hike brigade, Michael Hartnett, who's the top research analyst at Bank of America, Merrill Lynch, shows no less than 75 global rate hikes year to date. That's the highest net percentage central banks hiking since 2008. And remember what happened back then. We're on the same par level with the hiking they were doing back in '08 and the crisis that followed. So when you combine stocks and bonds, this has been the worst start to a year for a 60-40 stock bond portfolio since the record began. So it's worse than 2009 and worse than 2020 as of this point in the year, right here. So it seems like nothing's really working so far this year. And then, of course, everyone, you can remember the term TINA. There is no alternative. And so this was being shoved around by Wall Street because the dividends on bonds were way underpaying compared to dividends on stocks. So why would you want to own bonds when stocks are paying such a higher dividend yield? Well, look no further than what's happened now. Tina is dead and the Fed killed her. So with all the expected rate hikes and such, you've seen massive upticks in yields across the whole bond spectrum. And now a 10-year US Treasury bond is paying more than twice what the S&P dividend yield is. So all of a sudden, yes, there is an alternative to TINA, as I referenced on the first title page when we started the presentation. So, what's going on in the world as we speak? Here are some recent headlines. Goldman Trader, the best days are behind us, and we've never seen a setup quite like this before. The IMF slashes global growth outlook, blames Putin, fears social unrest and global instability. The global fertilizer shortage means that far less food will be grown all over the planet in 2022. Turkey mulls jail for publishing unapproved economic data. So here we go. I mean, they're just openly saying that fake news economic data will be published by central banks and governments around the world to make things look better than what they truly are. Bank of America, I'm so bearish, even I'm miserable. One bank's clients crack, yet the real selling is only just starting. And we will be touching on a couple of these things as we go through the following slides. Stagflation fears soar as the World Bank slashes global growth outlook. Sri Lanka warns of foreign debt default to save dollars amid socio-economic crisis. Top Washington think tank warns global recession could arrive before the end of 2022, even though Wall Street's been pushing it out to late 23 to try and tell everyone to buy the dip and stay invested at all costs. Bank of America. Every Fed hiking cycle ends with default and bankruptcy of governments, banks, and investors. This is something I have been on ad nauseum each of the updates we've been doing. JP Morgan admits central banks need a recession to cure inflation. That's absolutely right, and that's what the central banks are gunning for. They want to create a recession. They want to crash the economy to get inflation back under control. And finally, the gem of the lot, Goldman quietly sells billions in stocks for the third quarter in a row. And just remember, last time Goldman was aggressively selling into a supportive market, well, we just have to go all the way back to 2007 and 2008 when Goldman was busy creating the very CDOs, collateralized debt obligations, which its prop desk would then aggressively short. We all remember how prophetic that particular move turned out to be. So follow the big boys, follow the money. What are they doing? So meanwhile, with all this going on and all these headlines, the 30-year mortgage rate just hit 5.25%. This is the highest since 2009. What do you think that's going to do to potential buyers in the real estate market? So yes, understand, as I've been saying, 2000 was a tech bubble, 2007 was a real estate bubble. This is the mother of all bubbles because it's a bubble in everything. Stocks, bonds, real estate, corporation valuations on companies that are being sold, debt across the spectrum at all levels. So we've got a lot of adjusting across a lot of different areas and across the entire spectrum. But back to this, specifically to real estate, what this has done, there is now 9 million Americans that are priced out of housing market as affordability crisis worsens. So this is a chart from Bank of America, but you'll see right here, this is a record plunge in affordability because of the extremely high valuation of houses coupled with the increasing mortgage rates, which just makes it more and more difficult for anyone to be able to afford a house, except the richest of the rich that are out there. So, as you've seen in some headlines out there and stories, that there's I think more than 50% of Americans that believe that the American dream is dead. And this is probably a big part of that, coupled with inflation and everything else that's going on in the world. So looking at total consumer debt, our world runs on debt. Looking at this is a record high. This is people spending money on credit cards to just simply live and get by day to day. This does not bode well for the broader scope of everything that we're going to have to go through moving forward as everything plays out. Because when you add in, looking at inflation itself, this is a consumer price index. So consumer prices soar at the fastest in over 40 years. This is the highest since 1981. So think about as everything in your average day-to-day life is getting more expensive, i.e. that's what inflation is, then hence that's why we see the debt piling on. People just are struggling to keep their heads above water, let alone all this talk about the strongest economy ever that are claimed by some. And then looking at inflation itself, Putin versus not Putin, or Putin, however you want to pronounce it, but looking at the historical, this was back through, the Obama years and then the Trump years, and then Biden was elected into office right here at the end of 2020. And look at what inflation has done since he was elected. Up until right here, remember, Putin didn't invade Ukraine until, February of this year? So this last little piece of inflation, okay, maybe you could attribute this last 0.5% to Putin. And yes, obviously, everything that's going on over there is just going to exacerbate and make even worse what's going on with inflation. But understand the reality, not what the news media is telling you, but the reality that inflation was already running unchecked and out of control long before the invasion of Ukraine occurred. So this is just a look at reality. There's no political statement or anything else that I'm talking about here. It's just what has really happened up till now. So, what does this mean for the average American's misery? So, finally, this is all happening against the backdrop of severe economic malaise in America. Instead of relying on the traditional misery index, which relies on the unemployment rate, which in turn is entirely dependent on the participation rate, we go straight to the source and create an alternative misery index, which is combining the inflation rate and the percentage of Americans not participating in the workforce. And this is currently at a 40-year high of misery, right on par with the inflation on the CPI going back 40 years to 1981. So things are not well in Oz. So, and I don't mean Australia, I mean the wonderful world, World of Oz or Wizard of Oz. Everything is a fantasy world out there right now. All I'm doing is bringing a rational, logical example of reality to you to make better decisions with what you're doing with your finances, i.e. the stock market. But even beyond that, just thinking about being prepared for much, much tougher times as we move forward, above and beyond whatever happens with the stock market and everyone's wealth collapsing. So speaking to that point, the S&P price to sales ratio finished 2021 at the most expensive level ever in history because of this gargantuan amount of free money that was printed by the Fed and was sent out by the federal government to withstand the rigors of everything that was going on with COVID and the pandemic and lockdowns and the economy shutting down and everything else. But the problem is the S&P just over this last year and a half shot out to most expensive levels ever. When you look at the equal weight S&P 500 price to sales ratio, the equal weight says, what took you so long to catch up? So looking back, it broke out to new all-time record highs and overpriced valuations back in 2009, and then extended them up into the 2015 to 19, and then splurged even higher on the egregious amount of money that were printed after 2020. So understand, it's not just a handful of big name tech stocks that are expanding the levels of the S&P. And when you have 5 tech stocks that account for 25% of the S&P's performance, that's huge, that's massive. But what this is showing is that this is everything out there across the entire US markets is egregiously overvalued and out of whack. So really, there are no safe areas or safe havens to move to when it comes to S&P stocks. And of course, the reason why everything is so egregiously overvalued and disconnected from fundamentals and economic reality is, as I keep pounding the desk on, it's the central banks themselves. So when you look at, explaining 90% of the world, this is all the markets around the world combined, not just the S&P, but the chart below plots the G4 central bank balance sheet, the Fed, the European Central Bank, the Bank of Japan, and the Bank of England as a percentage of GDP of the US, the Eurozone, Japan, and UK against the MSCI All Countries World Index. And you'll see, tick for tick, the global stock market performance has been tick for tick with central banks expanding their balance sheets, which is what? Debt. They've just been printing money and buying stuff up, which effectively is them, just like us spending on a credit card. They have debt that they have to pay off in the future, or i.e. reduce their balance sheet. So when you think of it in those contexts, as I've been saying year after year, if we take debt out of the equation, we've had zero economic growth and zero stock market performance as well. That should be eye-opening to every single person out there. So, and of course, everyone's been talking about the inverted yield curves. So, what this one is, this is a 1 year forward look at the 2 year to 10 year Treasury spread, and you'll see we've hit a massive inversion on this time frame. And when you look back at the dot-com bubble, we've just peaked at those same levels. Coincidence? Methinks not. Do you think there's going to be a different outcome from what happened after 2000? No, we're going to see everything that happened back then on steroids, magnitudes worse. I mean, I've been telling people for a while now what happened in March of 2020, that was just the appetizer of what's really about to hit us and what we're going to have to deal with moving forward. So, as I mentioned on the headlines slide a little early, the IMF slashes global growth outlook, blames Putin, social unrest, global instability. Such a tectonic shift would cause long-run inefficiency losses, increase volatility, and represent a major challenge to the rules-based framework that has governed international and economic relations for the last 75 years. Understand, there are massive tectonic shifts going on around the world. We're moving back to a multipolar world. Russia and China are aligning. Countries all over the place are shutting down the shipment of exports of basic food stocks, wheats, fertilizers, all sorts of things, because everyone is so unsure that will they be able to import anything. So we better hold on to what we have, what we produce, because we don't know. If we send this out, we don't know if we're going to get anything back in return. But on the bigger scale, think about the economy versus inflation. You've got economic contraction heading into a recession or depression with out of control inflation. That is the base definition of stagflation. That's the worst of all. High inflation with recession at the same time. And that's what we're heading into, unfortunately. And on top of that, central banks are on course for their biggest tightening this century. So Michael Hartnett from Bank of America, as he puts it, COVID, the end of globalization, war, all in monetary fiscal excess, all these things that are going on in the past 2 years have resulted in generational inflation shock, which in turn has forced the shift from QE, quantitative easing, to QT, quantitative tightening, in 22 and 23. As the chart below shows, central banks are on course to hike more than 250 times in 2022. This is the biggest tightening of this century. So, but that's not all. Because when you think about, I've shown this chart many times in previous market updates. So every single time the Fed has gone on a rate hiking cycle, it's led to a drop, a crash, or a crisis. So here we go again. As much as everyone was saying on the way up, don't fight the Fed. The Fed's being easy. The Fed's providing stimulus and liquidity, and the markets can only do one thing. Well, now they're going into doing the exact opposite. So that same mantra stands. Don't fight the Fed. You'll see each time they've raised rates, it's led to any number of these different crises that you can look at. The most recent ones were the dot-com bubble in 2000, right here into 2007 when they were raising rates. It led into the 2007-2008 crisis. The last time they tried raising rates was up into 2018. That led to a 20 to 25% plunge in markets into Christmas of 2018, before the Fed did a 180-degree about face, and they said, oh, yeah, forget about that silly tightening stuff. We're going to cut rates back to zero and provide more stimulus, and everything's going to be wonderful, which they did, back to zero level. But how long? This is also, going back to that discussion of, without debt, there is no economic growth or stock market. This has all been done at 0% interest rates for extreme amounts of time. And also notice these rate hikes, they reach a lower and lower peak every single time because there's more and more debt on the shoulders at all levels of society. So rates can only go so high before it starts to cripple the economy. So As much as they say, we're in an out of control inflation. Last time we were at levels of the inflation that we said back to 1981, right? Is where inflation is today. Where were rates at? The Fed funds rate were at like 12%. We have the same inflation as 1981, yet the Fed funds rate is a 0.25. We've raised rates once. So in order to get the inflation under control, how much do they have to raise rates truly in reality? And hence, what's that do to the markets as a result? So everyone's bearish, but redemptions are just starting. So stocks are next. And as Michael Hartnett, B of A, concludes, everyone's bearish, but redemptions are just starting. Indeed, the selling has only just begun. Bear sentiment, waning war fear, Russian ruble, inflation peak, maybe, set up for bear rally, not bad. But central banks are the oncoming freight train and will tighten until credit and or the consumer break. That's what they, as we said earlier, the Fed has to create a recession. They have to crash the economy to get inflation under control. That's what this is saying here. But when you look, the all country world index has rolled over and has already been selling off. Yet global equity flows have been, this was on the back of all that money printing in March of 2020. But look, it doesn't even register. This hasn't even started rolling over for people to start selling yet. So when this turns around and adjusts back to more normal levels, how much further do the markets drop just on the actual money flows themselves as the Fed tightens and takes liquidity out of the equation? Then you add on to top of that margin debt. So margin is where people take their stock portfolio and they go to their broker dealer and they say, I want to borrow more money against my overpriced stocks to go out and buy even more overpriced stocks. That's what margin debt is. And it works great to the upside, but it works just as great to the downside as well. So what this chart's showing is the S&P 500 index versus the percentage change of margin debt. So this is a rate of change of debt, and anywhere above zero is where debt is being loaded on and increased, and margin is increasing against the stock market. But what you'll notice is when they have these big spikes in the rate of change, when they turn around and adjust lower, you get these breaking points. And this was a dot-com bubble. There was 2007. This was back in 2010, 2011. Right here, there was a big pullback in markets. But now, this is where we stand today. And the rate of change of margin debt has been slowing and has actually gone into reverse. So when now you look at total margin debt compared to, this is comparative to the broader New York Stock Exchange Index, you'll see that it goes tick for tick. So 2000, it turned around and collapsed. 2007 into the 2008 crisis. But you'll notice how stocks follow the margin debt. And I say stocks follow margin debt because you can see there are periods where margin debt was declining and stocks were disconnected. And this was why I was warning people in early 2020 that stocks were massively disconnected. COVID didn't crash the markets. COVID simply popped the bubble that was in markets, and things adjusted back down until the Fed jumped in and printed trillions of dollars out of thin air and everything else that we now know happened. But here we go. Margin has rolled over and it's declining. Stock market's going with it. But we haven't talked about the Fed's balance sheet. So this is comparing the green line of the Fed's balance sheet with the underlying total margin debt that we just saw compared to stocks. Margin debt's already rolled over and turned. But let's see what happens when the Fed's balance sheet starts pointing lower as well. Understand, the Fed's balance sheet to this day is still expanding. They're talking about maybe in May announcing that they will start quantitative tightening, which means decreasing the balance sheet as we move forward. So now you add rate hikes, you got margin debt already declining, and now you add the Fed's balance sheet going into reverse as well. What does that look like? From where we stand today, just over the next 2.5 years, they're looking at about a $3 trillion reduction. $3 trillion sucked out of the financial system and out of stocks in the stock market itself. Nothing good's going to happen from this, as it it never has before. Going into, they started tightening and reducing the balance sheet, and we had that collapse, 25% drop into Christmas of 2018, and then they turned around and started increasing things. And even when the Fed was being stimulative and cut rates to zero and were increasing their balance sheet, the crash in March of 2020 still occurred. So all the people that always say, the markets can't crash when the Fed's being stimulative, well, they just did in March of 2020. But now the Fed's going to actively be raising rates and decreasing their balance sheet. This is what is already being sniffed out by markets, and hence also why the smarter players are reducing their margin debt and paying off, where they can, while they can, before the bottom really drops out. And of course, mind the overshoot both ways. So Warren Buffett, one of your smartest investors of all times, this is the Buffett indicator comparing the composite market value to GDP. 2000, 2007, this is where we are now at all-time peaks, 200%. The market is priced double what the underlying economy is. So at 202%, 56% higher than the long-term trend line. So the exponential trend line suggests a market value to GDP ratio of 120% to be fairly valued. So you drop from 202 to 120 just on nominal terms, that's 80. That's a 40% drop just to get back to fairly valued. But you'll notice that this has on times and even long times stayed below long-term trends. And going back to the 80s and such, here's that period where there was a lot long-term underperformance of markets compared to the economy. There was a lot of inflation going on around here. So where will this truly end up going? Are we going to go, instead of just a 40% adjustment, do we go 50, 60, more? I guess we're going to find out as we move forward. But to that point, and markets in specific, looking at the S&P, so S&P support levels, each one of these lines are different technical support levels for stocks towards the downside. And this is Miss Shedlock, who I'm quoting here, and this is his work. He says, down to 3,600 would be a 25% decline, 32 would be 34. Back to the 2000 level. And remember this number right here. That's a 60% decline to get back to the 2000 levels. So he says, I'm confident 3,600 will not hold, but even if it did, what would the wealth impact have on demand destruction? The minimum decline I see from the top based on valuation is 50%. With that decline on the S&P 500, the more speculative NASDAQ will be down around 70%. And so things like ARK, that we talked about at the start, will be down 90% or so. So taking back all the gains to 2016 or 2014 is a strong possibility. That would be a decline to the 1800 to 2000 level, i.e. about a 60% drop or more. Curiously, that level would not make stocks a scorching major bear market, PE buy, but rather something reasonably priced. So we're talking about a 60% decline in stocks just to get back to being reasonably priced, let alone, pure bear markets. And he goes on to say, in a worst case scenario, he thinks 1,200 to 1,500 level holds as a worst case scenario. That's down here in this range. And that's getting down to around the peak of the 2007 bubble. So understand just how egregiously overvalued it is. Reality always wins out in the end. And reality is dictating anywhere between a 60 to an 80% decline from where we stand today. Which is all very interesting when you consider going back to Q2 2021 market update that I did. I showed this chart below. And what it shows is the blue line is the S&P 500 index. The orange line is your corporate profits. And you'll see that historically, these two have run very much in lockstep until we started the bubble finance period of the dot-com bubble, which then the two then reconnected. 2007 bubble and the recession and crisis, and the two declined together. But now you see this disconnect between stocks and actual economic reality. And I said at the time that the corporate profits indicate that the S&P should be at about the 2000 level. There's that 2000 level again, and I was talking about this back in Q2 21. But think about when a recession bites hard, how much lower that those corporate profits would drop, and hence the S&P would follow the corporate profits lower, just like they did in 2008. So now we get into a recession. Where are we dropping to? Are we getting down around those 1200 to 1500 levels for the S&P that Mish just talked about? Then if you add on top of that, back in Q3 of 2020, I showed this chart. And so this chart was put out by Sven Henrik. You see him on MSNBC and the financial networks. He's the Northman trader. He's an expert at technical analysis. But he was showing this megaphone pattern. And for this pattern to complete, then the S&P would be around the 2000 mark on this pattern. Now, of course, central banks printing money, this shot off to the upside and broke to the outside of the megaphone pattern. But as it turns out, just because a pattern gets broken doesn't mean it gets invalidated. And so you can have false breakouts to the upside and to the downside. But now with all the different technical targets we're talking about, this was as of 21, you extend this to 22, that's about the 2000 level. Now we're moving towards 23. We could be aiming anywhere between that 1800 to 2000 range as this S&P rolls over and collapses back down. So now you have multiple different factors that I've been pointing out over the last couple of years, combining with all the recent analysis, all pointing to a convergence around that 1800 to 2000 range. So this is not a coincidence. This is more and more evidence building up of what is to come. And of course, all these market, don't take my word for it. You can go to omniacm.com, go to the market updates tab, and you can find all of our historical market updates. And you can go and look for yourself to verify that I did indeed talk about these things at those points in time. So, investing is a journey, but it is managing the risks along the way that is the critical part. For example, here is our 100% US equity fund. Notice how it was protected during the crash into 2018. The blue line is your broad equal weight US index. The orange line is the performance of the fund. You'll see we were protected in 2018 and also March of 2020. In addition, it has also avoided the beginnings of this current downturn. And so as an end result, our US fund is beating the broad US equity markets by 14% as of Friday, April 22nd. Of course, you can find all 11 of our model funds at our website under the Fund Models tab. But you see, it's not about beating the markets here. It's about preserving client wealth and protecting their capital, because at some point here, markets are going to go down and they're going to stay down. Thinking about the out-of-control inflation and the pain, how much the Fed has to tighten and fight to get inflation under control. And there will not be an immediate printing of money with inflation still out of control, because we'd end up with hyperinflation and a completely lost value of the US dollar and basically end up like Weimar Germany. But they got to get inflation under control before they can do anything else. So looking at how long can it take to make back your losses? So this is the real S&P 500 index. So when you take the S&P 500 over its historical, going back to 1890, and you adjust the S&P for inflation, because we know inflation, takes away the value of all things, including stock market performance and value of the dollar. So when you adjust this, and when you look at peak to trough and back again, how long does it take to simply make back your losses? That's 26 years. This was the 1929 bubble, and through the 1930s depression and all the way up into the 50s, it took 29 years to make losses back. Going in through the 70s with all the inflation problems and everything else, that was 23 years to make back losses. And then even from the dot-com bubble it took 14 years. You see, the S&P on a nominal level basically made it back to its highs of 2000, but adjusted for inflation, it never got there. So that's a 14 to 16 year period to make back losses. So think about the pain that that is being projected that we're going to go through. That's why I pound the desk about preserving client wealth and protecting the capital. If we avoid the losses in the first place, we don't have to waste time making losses back, which hence the results, the returns take care of themselves. And that's how you beat the markets, not by swinging for the fences and taking huge risks. It's about holding on to wealth and not losing it in the first place. So please remember, don't fight the Fed. Lest we forget, back in 2007, Jim Cramer, I don't know who on earth listens to this clown, but back on October 31st, 2000, Cramer, in fact, I think now is the time you should be buying overvalued stocks. Move forward to today, April 21st, Cramer on NBC says Disney is a buy and that CEO Bob Chapek is the leader the company needs now. Does history ring true? History never repeats, but it does often rhyme. And so is Cramer, in fact, the harbinger of doom? I guess we're about to find out. So moving on with our different fund models. So this is our conservative total return income fund. It's half stocks, half bonds, mainly US focused. Since inception up till today, it is actually beating the US markets by 0.5%. Now, and you say, well, but what about all those stocks that have collapsed? What about the bonds that have dropped 20%? Well, that's why I say it doesn't matter what positions are in our funds. We try to hold on to, buy low, sell high, lock in profits, protect from losses. And so we've been avoiding the carnage and the drops that's been going on in the fixed income space. And that's how we're neck and neck with the equal weight US index. Our moderate global opportunity fund is still head to head. It's still underperforming US index by 8%. But understand, both of these funds are completely in cash as we speak. And yes, that's how we protect. We sell and we move to cash. If we're in cash and the markets go down, then we don't suffer any losses, do we? I mean, it's not rocket science, but you do have to have a strategy that works every time, and that's what we have. We'll touch on international markets and why the differentiation, or at least the relative underperformance compared to the conservative fund, and also between US fund and the international fund in just a second here. So here's the US fund. We already talked about that in the previous slide. But now when you look at our 100% international fund, so it's basically head to head. We started this in 2018. So head to head over that period, the international fund is only underperforming the US index by 3%. We avoided a lot of the carnage and the downturn in the international arena, and then we bought into some of the undervalued Asia Pacific and emerging market arenas, looking for a rebound and a bounce from there, but it just rolled over and dropped. So we took a little bit of an extra hit here. But the reality of the international arena, if we started our fund in August of 2018, right about here, this is the China ETF chart. You'll see that from 2018, as much as US markets just kept powering higher and higher and higher on the back of free central bank money, basically the US has been the cleanest dirty shirt in the hamper because we've had relatively positive rates of return with our interest rates compared to Europe, which has been negative interest rates through ridiculous amounts of bond buying, and in Japan by pure policy decree. So money goes where it's treated the best, and having actual positive to flat rates of interest rates in the US is what's driven so much capital into the US as compared to some of the other arenas out there. And so China had a little bit of an increased move here, but now it's just turned around and collapsed. And here was that little buy, and we had a massive reversal candle here, and we actually bought into some of those areas here looking for a continuation and a chance to lock in some gains. But it just rolled and dropped. So we're back out and 100% in cash. So we're actually in cash, conservative, moderate, US and international. We're in cash on all those funds, just as an FYI. And cash is a tactical position. It is part of the strategy. Now moving into our specialty fund arena. So this is our S&P fund. Now this uses a triple leveraged S&P ETF. So we only started it at the beginning of 2021, but you'll see how we were in cash. We found a couple of opportunities early on, and you'll see how quickly the fund caught up to the S&P because of that triple leverage. But then just being in the massive bubble that's been in, we're in cash for long periods of time waiting for a bigger adjustment and decline to give us an opportunity to get in at a relatively lower level. We got a false buy trigger here because we got in and it just rolled and dropped and we got hit. And then the same thing happened here again. This one's now currently in cash and will be so, as where S&P is below all major technical levels, no buy signals in sight. And so now it'll be for this one, I expect it to be in cash for quite a while as the S&P drops, which is great. The lower the S&P drops, the lower the point of entry we will get for a eventual upside move, and hence triple the leverage on that upside move. So short term, it's down 8%. Longer term, if the S&P drops 40 to 60% and we're only down 8, hey, that's a massive win and a beautiful opportunity to buy in at lows. Our precious metals fund. So this does use some double and triple levered ETFs in the miners and the metal space. But this one we started in June of 2020. So it caught an initial run up, and then it's sort of been this malaise and sideways move, and now it's started to have a move here to the upside. But the bigger picture, I'm very constructive, very bullish on precious metals moving forward. And here's why. Looking at this is the gold ETF chart. So, above and beyond inflation and interest rates and economy and recession and ultimate more stimulus and fulfilling Gagillion Dr. Evil dollars printed out of thin air, looking at the technicals on this. What this was the peak of 2011. Then we had this drop in the sideways consolidation, the run up into the middle of 2020. So we started our fund right here in June of 2020. So we caught that last little peak, and then there's been this malaise and this sideways chop, and now it's started to turn and run again. But bigger picture, this, technically speaking, from a chartist perspective, this is a massive cup and handle pattern here. And this indicates a huge amount of upside moving forward. If this technical pattern plays out and holds, indicators are still pointing up. Problem being that I do think that when the selling really hits hard on the equity markets, it's going to be a situation of, traders are going to throw out the baby with the bathwater and the bathtub, meaning correlations will go to 1 and they're just going to sell everything they possibly can because they're going to have to pay off margin debt on those massive amounts of margin that are in the markets. So everything that's not nailed down will probably be sold just to try and raise capital, raise cash to pay off margin calls. So, big picture, I think this is I'm very bullish on precious metals. In the shorter term, we're going to have to see how things play out and how cross asset classes are affected when the selling really gets going. That said, moving on to our Bitcoin fund. So we started this at the same time, June of 2020. Caught the first spike and run up, and then there was a drop and a pullback, and we got caught on some of the downside moves. Understand, cryptos are extremely volatile asset class, where you can have a 10, 15, 25% move in one day to either the upside and or the downside. So if you catch it or miss it at the wrong time, then it's going to have a big impact on the underlying performance. So here there was a second peak that basically reached the same heights in November, and then the decline ever since November of last year. But you see, we missed some of the bigger up moves, just caught some of it, and then we caught some of the down moves on the backside, looking for a good entry point. We are currently in cash. on Bitcoin. It's still up, almost 30% since we started it. But if people are going to play in this arena, they've got to understand the underlying volatility and the difficulty of trying to actively manage an asset class like this. But we don't buy Bitcoin to own the coin. We buy it, we invest in it to try and get access to the performance of the underlying asset class. And so, looking at where Bitcoin itself is as we stand today, right around the 39,000 level, going back to Sven Henrik, he did some analysis on Bitcoin recently, and technically, you can't really see it clearly on this chart, but technically speaking, he says that there is plenty of potential for Bitcoin to drop as low as 20,000. So when you think about, cryptos have traded very much as a risk equity, as a risk asset class, and traded pretty well in lockstock with the underlying equity markets. Then if we have a bigger sell-off, then I would totally see cryptos getting creamed as well, and having that downward thrust and push, which would have the potential to push down to that 20,000 level, which would be a beautiful entry point from the long side. But looking back historically, this could be a bear flag, as Sven pointed out, where you have the drop, the consolidation, and then an additional drop. And when you look back to the 2018 period, you had one spike, two spike, you had the pullback, the consolidation, and then the crash into Christmas. And then that's when the Fed flipped and things turned around, and it took off again. So do we have a similar pattern play out with the bear flag playing out to 20,000? I hope so, because we're in cash on our crypto funds, and that would give us a beautiful entry point around the 20,000 level. Case in point, when you look at the stock to flow modeling chart, the underlying blue line is your stock to flow, and it's says that the valuation of Bitcoin should be around that $100,000 per coin level. So currently we're sitting at about 30. If we pull back to 20, and then at some point, we get another massive round of stimulus and money printing from the Fed, you go from 20,000 to 100,000 just to hit it, let alone if you overshoot, as it has had a tendency to do in different times, then you could be looking at 200,000 from 20. That's a tenfold increase. Who knows if that will happen? But the lower we can get in, the more upside potential and total performance there is to be had down the road, as Bitcoin does continue to adhere to its stock to flow modeling chart. So our Ethereum fund, unfortunately, we started this in November of 21, and that was right at the peak of the crypto markets. And so as you see, there were periods of time, anytime the chart's flat, we were in cash, and we were looking for entry points to get in. But the problem is that when you have a downward moving asset class, it's very difficult to make money. And so each time we tried to get in, tried to find a bottom, got a buy signal, we'd get in, and then it would turn and drop again. But it did bottom around early March, and we were able to pick up some growth, and then it rolled over again. So we're currently in cash on both Bitcoin and Ethereum, as you can see right here. We want a bigger drop and wash out in those sectors now, because that'll give us a lower entry point to get back in and avoid those losses. Speaking of other downward dogs, cannabis. So we started our cannabis fund in November of 2020. We caught the run up. It had that big run up into early 21, and then it's just been a major downward dog ever since. So the same thing, it's been buying in long periods of time in cash, trying to avoid the downturn, and then getting buy signals and for things to just turn lower once more. So we're currently in cash on this fund. But the bigger picture on cannabis is, think about when, and this is one of the ETFs we use in that fund, POTX. So you got to love the names in the cannabis. It's POTX, THCX, MJ, Mary Jane, MJXL, and then what was the other one? Oh, YOLO, YOLO. But still, we started the fund here in November, and then we caught this early run up, early part of 21, and then you just kept getting these false breakouts and false buy signals, and it's like a death of 1,000 cuts. But we picked up a little bit of move up here towards the end, and then it rolled over. So we're back in cash and avoiding this downturn. So we'll see, where this one goes. But cannabis, think about, there's a bigger play on this. As many cities and states and everything else that have already legalized it now. Apparently, a few weeks ago, Biden was looking at putting forward a bill to maybe legalize cannabis on the federal level. But think about this: when that legalization comes, cannabis, this whole sector as an asset class, is going to take off to the moon, because once there's legalization, you're going to have all the big alcohol, tobacco, and pharmaceutical companies coming in and buying up all these mum and pops shops that are out there, and this whole sector is going to take off to the moon. There'll be a massive growth area, especially once they give federal legalization and everyone can jump in with both hands and feet. So, and then finally, our last fund is our commodities fund. So think about the inflation that's raging out of control. Commodities, your core basic building blocks of any economic construct. The commodity sector have really benefited from all the inflation that's going on. But bigger picture, think about all those headlines and stories we're reading about, and Russia's, the biggest fertilizer exporter of the world, and they've stopped shipping fertilizer. Well, if no one has fertilizer, then they can't fertilize crops. If crops aren't fertilizers, food doesn't grow. So think about, and with our commodity, and let alone the export shutdowns that countries have been doing, so people aren't exporting wheats or grains, or everyone's holding on to what they have because they don't know what the future holds. And our commodities fund is heavily in grains, agriculture, wheat, coffee. We have some rare earth minerals and some uranium plays in there, but really that whole food arena is a heavy focal point of commodities, and with everything that we're seeing out there, food shortages, crises, everything else, there is still plenty of upside in the food and agricultural arena for plenty more inflation still yet to come. So similar to precious metals, I'm still very constructive and bullish on the commodities space as well. Doesn't mean that it won't, get slammed with stocks if there's, the selling really gets started. But if it does, we'll hit our sell triggers, move to cash, let things drop, and then we'll be right back in at much lower levels for overall growth and accumulation of performance. So with all that, and especially the thoughts of where the predictions are and real valuations and equally fairly valued levels of the S&P, then there's a lot of downside potential heading forward. So hence, our final chart, actually, I misspoke before, our long short contrarian fund, so shorting the market, playing the other side of the equation. You'll see in March of 2020, this one shot off to the moon when the markets collapsed, and we were actually beating markets by about 75% at that point. But with all the stimulus and free money and everything else, with the S&P just marching higher, forget about what this has done, and it's flattened out and gone nowhere for a year and a half. The S&P itself kept marching higher, and so shorting a permanently higher market is, it's been a bear of a time, no pun intended, for this fund trying to fight central bankers. However, we've bottomed out and turned a corner. And so as markets roll over and collapse, I'm really interested to see where this fund will spike and go to, especially considering the exposures that we're currently holding in there. But on a total basis, this looks, the performance is not impressive. However, think of it on a real-time basis. Just since the bottom on January 12th, that was the low point for the long short fund. It's up 51% since then. So the people that have gotten into this fund over the last couple of months have done well, and especially considering, what could be expected, what's the potential returns for this fund. I mean, basically, when you short the market, it's just, it's buying the bottom of a market at the all-time lows is the same as shorting a market at the all-time highs. All you're doing is you're making a bet on the relative change of direction of the underlying assets. So when you can look at it from a pragmatic standpoint, then there's always opportunities and areas for potential growth. It's just a matter of if it's not meant for everyone. Everyone has their own thresholds and their own comfort levels, but as far as a pure opportunity for growth, then buying at the lows, we are effectively, that's what we're doing here. We're buying at the lows on this fund, looking for the change of direction on the market. So, once again, we'll see where things go. So, experience is an expensive commodity to acquire, which is why it's always cheaper to learn from the mistakes of others. Got protection? We do, and we're here to help. So that wraps up our presentation for the day, and hopefully all this was insightful and helpful and gives you a broader scope and perspective on the reality of what's truly going on out there and where we are more than likely headed. I know where my money's placed, but here's all of my contact information, my cell phone, my email, creader@omniacm.com, and then our website is omniacm.com with all those, the links. The fund models are on there, and some the market updates are on there, and just some broader perspectives on full market cycles to help you understand and navigate markets out there, whether you do it yourself or if ultimately you'll look to us to help you with your investment management needs. We're here to help. So take care. Best of luck to you. We're all going to need it.